Disclaimer: this video is for educational purposes only and is not financial advice. Always do your own research before investing.
When geopolitical risk spikes, a conflict in the Middle East, sanction on a major producer, OPEC plus cutting supply, energy is usually one of the only sectors that benefits while everything else sells off. Okay guys, the first on the list is ENCC, offered by Global X Canadian Oil and Gas Equity Covered Call ETF. This is equal weighted basket of Canada's largest oil and gas producers, for example, Cenovus, Suncor, Imperial Oil, and TC Energy. The strategy is paired with the dynamic covered call writing, but it has no leverage or USA equity exposure. Looking at the top holdings of the stock, as you can see, around 34% of the holding is from NRGY, which is their own equal weighted oil and gas index fund, which is basically the plain vanilla version of this ENCC without any leverage or covered call. Followed by the Cenovus Energy, then ARC, then we have Whitecap, Pembina, Southbow, Suncor, TC, Imperial Oil, and Kiara. Most of them spread around 5 to 6% in the portfolio. Now let's look at how this yield coming together around 11.72%. So basically 3.25% yield is coming from the underlying stock. As we all know that most of the Canadian oil and gas companies does pay dividend, mostly monthly or quarterly. And then they write a covered call around 41% of the portfolio, which generate around 8.4% yield. Combined, we are getting 11.72% in our pocket each month. Now let's look at the performance of the stock. So in the last 5 years, as you can see, we have very impressive 236% return. But if we switch to 3 years, it still have very good 81% return. And the last 1 year, it has produced around 40%, which is very, very impressive. Before you buy, you make sure you look at the kind of fees you're paying here. The management fee is 0.65. And MER, which is the total fees paid by the fund, is 0.92% with a net asset value of around 782 million. And the risk ranking is high because the covered call nature of the stock. The next one on the list is ENCL, which is basically ENCC, but with extra 25% leverage from the borrowed money. It is not a different strategy. It is ENCC basket run at roughly 125% exposure. 100% of your capital plus about 25% borrowed money via cash leverage. So the underlying strategy deploying extra leverage cash of 25% on top of 100% capital money, and it comes together to be 125%, which is working extra time to make us extra dividend. Is the breakdown of the yield we are getting. Around 4% we are getting from the underlying stocks, and 10.59% we are getting from the option yield by playing dynamic covered call program. Altogether, we are getting around 14.65 indicative yield. At the 3-year chart, it will show 87% return, which is really nice. And then 1-year chart is showing 50%, which is again very impressive. Again, the ENCL being a newer on the list hasn't seen a big drawdown or slowdown into the energy stocks. That's why the overall performance is very impressive. Now, what you're paying to acquire this ETF? Again, you're paying very high 1.8% MER because this is an enhanced version of ENCC, and you are paying roughly the double what ENCC would have charged you. Next one on the list is EMAX from Hamilton Energy Yield Maximizer ETF. Unlike ENCC and ENCL, this one crosses the border and has US holdings. This is an equal basket of North American energy names, 19.3% from Canada and 80% from United States. The few names are Valero, Marathon Petroleum, EOG on the US side, and Imperial, Cenovus, Suncor on the Canadian side. All the core holding, which is 20 in this case, equal weighted around 5%. The names are Valero, Marathon, Texas, Phillips, EOG, Diamond Bag, Baker, Imperial, Cenovus, Halliburton, SLB, Expand, EQT, CNQ, Exxon, Devon, Suncor, ConocoPhillips, Occidental, and Chevron. The coverage ratio isn't fixed like ENCC's 41%. It is actively managed, flexing higher or lower depending upon market condition, and no leverage in this ETF. The monthly income coming is 10.887% at the current annualized yield. If you look at the 3-year chart performance, it is 42% return, which is still good, but not as good as ENCC or ENCL. The 1-year return is around 37.2%. Looking at the management fee, it has 0.65 management fee, and the rating is medium to high because there is no leverage involved and it is actively managed fund. One important thing is EMAX is actively managed against a blended benchmark coverage ratio and holding can shift at the manager's discretion. Under 3 years of history means it hasn't been tested thorough full energy cycle yet. The next one on the list is HPF, the Harvest Energy Leader Income Fund ETF. This is the only fund in the series that goes truly global, 20 equal weighted energy majors spanning Canada, US, Europe, Enbridge, TC Energy, Pembina, CNQ, Suncor on the Canadian side, Exxon, Chevron, Valero, EOG from the US side, and then Shell, BP, Total Energy, Equinor, ENI rounding out from the European sleeve. If you look at the composition, the European exposure is the real differentiator, roughly a quarter of the fund, and it is not in any other fund in the series. The core holding, which is 20 in this case, equally weighted and rebalanced quarterly, and the few names are Valero, HFs, Pembina, Phillips, Enbridge, TC, EOG, Oventiv, CNQ, Exxon, Chevron, Conoco, Occidental, ENI, Shell, SLB, Total, Equinor, Suncor, and BP. We are getting 2.5 cent every month for last 4 years, which brings out to be 7.7% current yield. Let's look at the 5-year performance, and you can see it has really impressive 124% return over the 5-year period. And if you look at 3 year, it has 52%, and 1 year, it has impressive 42.9% positive return. Looking at the management fee table, we can see 0.85% management fee, which is fairly standard in the segment. And with the asset under management of 65 million and inception is October 2024, HPF is the smallest and oldest fund covered so far with over a decade of history, including 2014 to 2016 oil crash and 2020 collapse. Distributions are actually managed and can change at any time. The current flat streak isn't granted either. The next one on the list is NXF, the CI Energy Giant Covered Call ETF. The most hands-on approach in this series, actively managed, no fixed index, equal weighted basket of at least 15 of the world's largest energy company with no fixed distribution amount. This is the only fund in the series with the Brazil in the mix. Geographic split is 39.6% is from United States, 20% from Canada, 13% from United Kingdom, 7% from France, 6.9% from Brazil, 6.8% from Italy, and 6.1% from Norway. Petrobras is the standout name here, a South American energy giant with a very different risk profile than the North Sea and Gulf Coast names dominating the rest of the series. Top holding Suncor at 7%, Total Energy at 7%, Petrobras at 6.9%, Diamondback Energy at 6.8%, ENI at 6.5%. Portfolio mix is roughly 40% international active, 40% US, and 20% Canadian equity. Generally, three-way global and active rebalance rather than locked to an index. CA is explicit. NXF does not have a fixed distribution amount. Payout have ranged from about 3 cent to 11 cent per unit. The most variable pattern in this series. Annual total have swung from 42 cent in 2025 to 94 cent in 2022. Trailing 12-month yield is around 8.5%. Let's look at the 5-year performance chart for the total returns. As you can see, 139% in 5 years is really impressive. And if you look at 3-year chart, it's 44%, and 1 year is 34%. The management fee is 0.65, with MER fee is 0.71. Net asset is 137 million. Leverage is none. NXF doesn't track a published index, so holding coverage ratio and even the number of the name can shift at manager discretion. Combined with the variable payout, this fund asks for more trust than the rules-based funds in the series in exchange for genuinely differentiated global exposure, including Brazil. The next one on the list is ZWEN or ZWEN, the BMO Covered Call Energy ETF, a rule-based screen for quality, growth, and yield, layered with a covered call overlay. Unlike the producer's heavy basket elsewhere in the series, nearly 30% of ZWEN sits in the energy services and equipment, not just production. 4 criteria, not a fixed index: quality, financial strength, and durability, growth potential, room to grow, not just yield today. Yield, dividend income from the underlying stocks, and liquidity. Deep enough options market to write calls efficiently, a middle path between ENCC's fixed index and NXF's full discretion. In sector mix, 70% come from energy, minerals, 29% from industrial services. And in geographical mix, North America contributes around 79%, 20% from Europe. And in top holding, Valero Energy sits around 5% and Total Energy at 5%. The indicated distribution is around 8%, paid 12 times a year, which is monthly. Like every BMO covered call ETF, the amount is set at the manager discretion each period, not a fixed target. Okay, let's look at the 3-year performance with 67% return, which is very impressive, and 1-year return is 38.5%, which is again really good. With the MER fee of 0.73% and the net asset under management 128 million, and inception is 2023 January, leverage is non-risk because rating is high. Next one is Oily, the Evolve Canadian Energy Enhanced Yield Index Fund, the wild card of entire series. Just 10 stocks, 125% leverage, and the highest yield you will find anywhere in this lineups. So buckle up. 10 names, that's it. Suncor at 11%, Whitecap at 10%, Cenovus at another 10%, TSC Energy at 10%, CNQ or Canadian Natural at 10%, and 5 more rounding up the rest. Compare this to EMAX or HPF's 20 holding or even NXF's 15 plus. Here, every single stock is doing double the work. One bad earning call and you will feel it. Like ENCL, Oily runs at roughly 125% exposure, but on a tighter leash. If more than 2% above 25% target, it is pulled back within 2 business days. The covered call overlay is just as aggressive. The manager can write calls on up to 100% of the fund's value at their discretion. No fixed formula here, just judgmental call made fast. And here's the twist. While other funds in this series have flat or declining distribution, Oily's has actually gone up from 11 cent to 13, then 13 to 14.7 per unit. Trailing 12-month yield is around 14.5%. This is the highest number in this whole series. The newest fund paying the biggest check. Let's look at the performance because it's a new fund, so just over a year, launched in March 2025. So we don't have all 3-year chart, but if you look at it, since inception, it has 42% return, which is really impressive, and then 1 year is 46%. Looking at the management fee of 0.6%, which is fairly standard in the market, the cheapest fee in the series, and under management is 40 million. The smallest inception is March, which is fairly new. The youngest by long shot, leverage is 125%, 10 holding, high risk rating in the entire lineup. The lowest fee doesn't buy you safety here, but it buy you the single most concentrated, most leveraged bet on the list. The next one is XEG, the iShares S&P TSS Capped Energy Index ETF. No options, no leverage, no discretion. Just straight equity ownership of Canada's largest energy companies. This is the benchmark every covered call fund in this series is quarterly measured against. Distribution yield is only 2.9%. No options premium boosting the payout, just dividends paid quarterly. 1 year total return is 45 to 57%. Full participation in the energy rally, nothing capped by written call. That gap between XEG is 2.9% yield and the 8 to 15% range of its covered call peers. That's the trade we are making. Every other fund in this series convert future upside into cash paid today. XEG keeps all the upside and none of the extra cash flow. Cap weighted, not equally weighted. Suncor and Canadian Natural Resources alone make up roughly half of their fund. Top 10 holding 88% of the entire fund. Technically 27 names, but it behaves much more like a 5 or 6 stock bets. 12-month trailing yield is 2.93 or around 3% paid quarterly, not monthly. A real difference if you're budgeting income month to month. What XEG pay is simple, what the underlying companies pay. Pass through the net of the fund small fee. If you look at the performance of 5-year chart, we can see clearly it outperformed any other fund we discussed in this video at 305%. And then 3-year chart, almost 100%, 94% return. And then 1-year chart, whopping 59% return. With management fee of 0.55% and MER fee of 0.6%, net asset is 2.3 billion, by far the largest fund in the series. Inception is March 2001, the oldest by 2 decades. No leverage, no option overlay. Worth knowing, no leverage doesn't mean low risk. XEG's return swing hard with oil and gas prices, and nearly 90% of the funds ride on just 10 stocks. Next one is ZEO or ZEO, the BMO Equal Weight Oil and Gas Index ETF. This is the fund the whole ENCC story runs on top. Same equal weight Canadian oil and gas index lineage, just without the covered call overlay. Side by side, ZEO holds 12 names, equal weight, no covered calls, no leverage, full upside participation. ENCC holds 10 names inside the NRGY core, plus 41% coverage, no leverage, upside capped where calls are written. If energy stocks run hard, ZEO keeps more of the gain. If they chop sideways, ENCC's overslay tend to produce more cash. 12 names quarterly rebalanced roughly 8% each. Synovus at 12.7%, Suncor at 9.09%, Whitecap at 8.75%, and Canadian Natural at 8.5%, and Imperial Oil at 8.22%, TC Energy at 8%, top 10 of 12 holding 86% of the fund. Trailing 12-month yield is 2.8%, just dividends, no option premium. Comparing ZEO to ENCC, one yield alone means comparing roughly 3% to roughly 11%, and the entire gap is the covered call layer. Let's have a look at the performance of the ZEO over 5-year period. You can see 230% return, which is very impressive. And the 3-year is almost 100%, and 1 year is 51%. Looking at the management fee of 0.55% with the MER fees 0.6%, net asset value of $323 million. Inception is October 2009. This is the second oldest fund in the series behind only XEG. No leverage, no option overlays, same high risk rating as it is covered call cousins. The equal weight structure and small 12 name count means individual stock moved very hard. The last one on the list is HXE, the Global X S&P TX Capped Energy Index Corporate Class ETF. And here's the twist to close out the series. These funds pay you nothing. Zero cash distribution by design. After 9 funds built entirely around income, we end on the one that gives you none at all. No stocks are actually bought here. HXE mostly hold cash and enters a total return swap with large financial institution. The counterparty pays HXE the index total return. HXE pays back the interest on its cash. Every dividend that underlying companies would have paid gets folded straight into the share price instead. That's why there's nothing to distribute. It also means counterparty risk, something XEG or ZEO simply don't carry. So why would anyone want zero income? In a taxable account, this is actually the whole point. Instead of paying tax on dividend every single year, gains stay deferred inside the funds until you sell. And then it's typically taxed as a capital gain, not income. No T3 slips, no annual tax bill, just grow quietly compounding. Looking at the 5-year performance of HXE, you can see it has a whopping 309% return over the 5-year period, and 3-year return is almost 100%, which is 96%, and 1-year return is 58%. MER fee is very minimal, which is 2.25%, a quarter of what most covered call funds in this series charge, and the lowest fee of any fund we have covered. Net asset is $124 million since inception 2013. Zero distribution swap-based structure, 25% cap per name. Worth knowing, HXE isn't eligible for the same treatment in every account type, and it carries counterparty risk that physically replication funds don't. It is polar opposite of everything else in the series. The last fund you would buy for cash flow and potentially one of the most efficient way to just hold Canadian energy and let it grow. So that's the countdown. 10 funds ranked not by yield, not by safety alone, but by which one actually deliver on income, growth, and risk control together. ENCC takes the top spot. Not the highest yielder, not the fastest grower, but the only fund that scores solidly across all 3 columns at once. At the bottom, as you go through the list, HXE. Not because it's risky, it's actually one of the safest structure here, but because zero income means it simply cannot compete on 2/3 of what its ranking measure against. And in between, you can see the trade-offs playing out. ENCL and Oily both leverage, both high yield, both pulled down by thin risk control score. XEG and ZEO, excellent growth and safety held back by yield barely above 2%. There is no single best ETF here, just the one that's the best balance for income and growth portfolio. If you are optimizing for something else, pure safety or maximum yield, this order would look completely different. So guys, here's the quick ranking of all the top 10 ETF available in Canada in energy sector. I hope you like this video. If you like it, give it a thumbs up and subscribe for my channel. Thank you very much.